This is a trade that was a really nice, beautiful trade just a couple of weeks ago before the market started to push lower. And then the market pushed lower, and now we are here. This is what this trade looked like earlier today if I didn't make any adjustments, right? So a couple of things going on here. The price definitely pushed deep into the structure, right? This is what I call the structure. It's kind of like a profit tent. Right? It's an unbalanced put butterfly, and the price went all the way down into the tent. We came down, but we didn't really take out the downside break even point. And that's the level that I'm kind of watching. Once we start to trade outside of the downside break even, I need to really change the entire structure of this trade, perhaps, because if the price continues lower, the longer I wait, right, the more my T plus zero is going to move towards this risk graph at expiration, meaning that this, if we're trading outside of the downside break even, right, let's say at 5,600, if I do nothing, I'm just kind of hoping for the price to go back inside the tent, the longer I sit here, right, my position is not going to improve over time. I'm actually taking a chance of price going further against me without any kind of benefit of potential improvement. Here, where we are right now, if I don't make any adjustments, yes, I am taking the risk of the price moving further against me, which it did earlier today. But if, we go up, we go down, we go up, we go down, but we stay inside of this structure, right? Every day, technically, right? This trade should improve because I have a long put debit spread and I have a short put credit spread. And if we are in fact inside of the structure, my long put debit spread, since it's partially in the money, is going to actually appreciate in value with every passing day. And my put credit spread, theoretically, is going to lose value with every passing day since I am short this put spread that's decaying, right? That's working in my favor. And I'm long a put debit spread, which is increasing in value since it's partially in the money. Both spreads are working in my favor. And you can see, maybe we can put some projected. These are T plus zero lines at different points in time, right? Hopefully you can see this, right? This, let's talk, or maybe, I could just, show you a projected, let's say, if we're still where we are right now at 58, call it 58.60, but not today, but 30 days from now, you can see that this trade's T plus zero is going to change drastically, right? So 30 days from now, if we're still inside the structure, this position is going to kind of self-heal, right? It's going to autocorrect. Because again, the value of the put debit spread is going to go up if it's partially or fully in the money, and the put credit spread is going to decay. But right now, right? Right now, even though we are in the trap, or if you want to call this inside this structure, right? This trade doesn't look very good. It's it definitely didn't feel any better earlier today with the market pushing under 57.50, right? So when I look at a position like this, I can say, well, I can choose to do nothing, right? And just kind of let it work itself out while I'm inside the structure, and that's great. But there's also a chance that if we move the following day 1% lower and now we're outside of the structure, I'm definitely going to have to act. I'm going to need to do something, right? What am I going to do? I can stop out of the trade, or I can possibly look for ways to move this put credit spread that's now going in the money further out, right? That's going to be a debit that could potentially take up more margin. If it doesn't take up any more margin, we're definitely going to shift risk from downside to the upside. It could potentially put me in the position where we'll have to wait all the way up until almost to expiration for this trade to come back. It's very possible that it'll come back, but if the market isn't going to calm down, and we're going to continue to see wild swings back and forth, it's just not going to be fun to hold. So instead of waiting for the price to move outside of the trap, earlier today when I looked at this trade with S&P being at around, I'm not sure what it was, maybe it was at 57, 60 or something like that. And I said, okay, what is my position delta? Meaning, right, how much exposure, directional exposure I have in this position. So my delta was about plus 35. And you can see if I move my cursor, this is the delta on this risk graph, and somewhere around 57, 80 maybe, right? You can see my delta was right around 35, 36. So I said, okay, you know what? Maybe we're going to continue lower. Maybe we're going to go higher. We don't know. But for right now, what I want to do is I want to remove as much delta as possible and neutralize my position. Not to totally zero. I don't want to go from plus 35 delta to zero delta. I want to leave a little bit of a bullish or positive delta, because if we look at the chart again, I'm not here to call a bottom, but after we already came down 5 or 6%, I think that odds are of a bounce are higher than market really rolling over and going much much lower. Could it happen? Yes, but I think that I would rather have net long delta in my position. If I was putting on a new position today, I would not want to start with a net short delta. I think getting short delta right now is it may be already a little bit too late. Now, obviously, if the market's going to roll over and completely sell off, then yes, I will be wrong. But if we're not going to assume that the market is going to crash, right? I don't think anybody should be trading assuming that the market is going to crash. If we just look at the chart, I think that odds of market going higher are a little bit higher than odds of market going lower. So therefore, I wanted to leave some positive delta. So what I decided to do, right, and we can do a little exercise and talk about what, let's say, if I wanted to do the same exact thing right now, right? Right now, assuming no adjustments were made, this position is showing a delta of plus 28. And this is a 10 lot, right? So for example, if I wanted to cut my delta in half, right, that means I need to pick up a negative about 14 or 15 delta, right? Plus 28 minus 15, right, will get me to about plus 13 net delta. So you can just look at maybe something as simple as buying a 15 delta put, right? Remember, the puts, they all have negative delta readings, right? So let's have a look at what will adding one put with negative, let's go with this 5,400. If I add one minus 15 delta put, this is how my delta is going to change. It's going to change from plus 28 to plus 13.3, right? I added a negative 15 delta put, and that reduced my delta from 28 to 13. I don't love this idea because I think that, well, number one, with implied volatility already high, or relatively speaking, on the higher end of the range, I think these puts are a little bit on the expensive side, right? So I wouldn't want to be buying a 15 delta put right now, because what happens is if we just pause a little bit, or if we start to go down but slowly and volatility come down, right? If volatility comes down and we continue down but slowly, this 15 delta put isn't going to do anything for me because it will start to lose some of its value. So even though I kind of fix my delta problem, right? This put doesn't give me what I need if it continues to move lower. So what I ended up doing instead, I just decided to use the options that I already have. And I said, what if I'll just roll the um, 10 long puts that I have at 56.70. I believe I rolled them up to 56.70 to 56.90. So I rolled them up 20 points, right? So from 56.70, we go to 56.90. It's the same exact thing as me buying a put debit spread, right? I'm buying a put at a higher strike price. I bought 56.90 and I sold 56.70. It wasn't by accident. I want to use options that I already have instead of just adding more options. But essentially, if you look at this trade as if this was a new trade, right? If I'm buying a 56.90, I bought a 32 delta put and I sold a 30 delta put, right? The difference between these two delta puts is about 2.5 or close to it. Let's call it 2, right? So what I did was each one of these put debit spreads has a negative delta of 2. I did 10 of these. So that shaved my delta by about 20 deltas. So you could see my delta goes from 28 to about 11 or 10. Right? So it's same exact thing. But instead of going out and buying a lower delta put, I just moved or I added a put debit spread a little bit closer at the money. So I know that if the market continues lower, but slowly, and volatility does in fact come out, right, this put debit spread is not going to get crushed because whatever I may lose with this long 56.90, I will gain almost as much with the short 56.70. Right. So to me, it's kind of a safer, a little bit more conservative of a hedge. Right. I'm not looking for the market to crash. So that's why I went with a put debit spread that's closer at the money. Now, if I was concerned, if I thought, oh my God, the market is going to crash here, whatever, then I would, instead of doing a put debit spread closer at the money, I would go with a farther out of the money long put because if we just compare long put farther out of the money versus a closer at the money put debit spread, long put will win if we do in fact see a big move down the following day or two, right? Because the long put has a lot more positive gamma, right? And gamma tells us about the rate of change of delta in that long put. So the put debit spread doesn't have that long gamma that naked put does have. But what happens is if the market does not crash and if we go higher, long puts are going to get completely smoked. Whereas the put debit spread, it's going to lose some value, but it's not going to get hurt as much as a um, long one put. Right. Hopefully this makes sense. If it doesn't, we can try again. But the idea, right? So I always say, if you are going to make any adjustments, first thing you want to do is you're trying to identify what it is that you're trying to accomplish, right? You want to make an adjustment. Why? Right? Because my trade is down too much. Okay. Your trade is down too much. You need to make an adjustment. What are you trying to accomplish? Well, I need to, remove some of my directional risk. Meaning, I don't. If the market goes up or down tomorrow, I don't know which way it's going to go. I don't care which way it's going to go. I just don't want. I kind of want to pause. I want to stop whatever is happening. The volatility in your daily P&L. Right. If you want to try to do that, then you obviously are looking to remove some of your directional exposure or your delta reading, right? And essentially, you're looking for a delta hedge, right? We're not hedging for volatility here. We're just trying to remove some of the positive delta. Removing positive delta helps if the market goes down tomorrow, right? Would you rather have plus 27 delta or plus 10? I think you would rather have plus 10 delta because with a plus 10 delta, you will lose $10 for every 1 point that the underlying asset is going against you versus $27 for every 1 point. Make sense? Um, Question: would the same adjustment strategy apply to 112s as well? I actually did something similar to one of my trades that I did a couple of weeks ago, right where the market started to roll over. I put on the trade and then the market went down. I made an adjustment as I planned for that trade, and I put my naked puts already at like 60 or close to 60 days out. And I didn't want to make yet another adjustment and extend the duration by more days because the next available contract was like 70 something days away. So what I needed to do is just needed to kind of freeze things in time. So what I did was um, I bought in a put, and I can you know what? I'll go over that in just a minute, but let's just finish up with this butterfly. So with the butterfly, what I did today, and again, did I do it at the perfect time? Absolutely not. Right? I did it as the market was pulling back, and I didn't want to play the chicken game, waiting. Hey, let's see what happens. Are we going to bounce? Are we going to roll over? I think it's silly, right? I mean, if you could time the market and you're really good at it, then sure, you can use that to your advantage. If you don't want to bother, and one of the probably worst things that can happen, I'll tell you this: a lot of newer traders, right? They'll see the markets pulling back. They know they need to do something, and they start to look at the charts and they're asking their cousins and they're going on CNBC and there's that and the other. And for whatever reason, they don't make an adjustment and the market will rally, right? Now they train themselves subconsciously to not follow the rules, to not do what they're actually supposed to be doing, right? But instead they're introducing other variables such as their cousin's chart reading skill and then the opinions of the traders on Twitter and whatever, right? Until that one day when the market is pulling back and they know they need to do something. And once again, they're on their charts and then they're asking left and right. And again, they don't make the adjustment. And instead of market rallying and helping them, the market goes the other way or further against them. And they put themselves in the position where now they're behind to make an adjustment. It's going to cost them a lot more than it should, right? Only because they didn't act and do what they did when they're supposed to do. So I didn't want to wait and kind of sit there and say, "Oh, I know how to time the market." I saw that the trade could potentially get out of, uh, or at least out of my control, right? I could only do things that I think I can control. So I can't control where the price is going to go, but I control how much exposure I have. So what I did was I ended up rolling my downside long puts up, right? I paid a debit. And what that adjustment did, and I'm going to show you. So this is what it would look like if I didn't make any adjustments. And this is what it looks like since I did make an adjustment. As you can see, my P&L is worse since I made the adjustment, right? Because I shaved off about 20 deltas in my position. So when the market reversed today and went from maybe 57.60 up to 58.50, right? So we had like maybe a 90-point rally. Well, that 90-point rally happened with me having 20 delta less, right? So I made $20 less per one of these 90 points at the market rally today. And that's okay with me, right? Because if the market didn't rally 90 points, but instead went 90 points the other way, I would have lost $20 less per 1 point if the market was to roll and head the other way, right? So I gave up some of the potential I could have made if I didn't make the adjustment, but that is the price of, having a peace of mind that if the market sells off hard tomorrow, I still could do some things to potentially improve my position. I do know that if I did make any adjustments, look at the risk graph at expiration, right? I have no upside risk. Since I made an adjustment and I paid a debit, right? I spent my tail profit and then some. So now I do have upside risk, meaning I can't leave this trade until expiration and do nothing, right? Because if the market runs higher and we end up, let's say, at 6,100 or at 6,050 or at 6,000, right? At expiration, I'm not going to lose as much, but I'm probably going to be down a couple of $1,000 in this trade, right? All options will have expired, worthless. I have a net debit in this trade right now to the upside. So I know that going forward, my job is to try to figure out a way to recover what I paid for the adjustment today by rolling my downside longs and to remove my upside risk. Obviously, if you have been following for some time, if you have seen these trades and how they work, I think the easiest way to do it, other than adding another butterfly, I don't want to push a lot more risk into this trade because we are at 43 DTE now. And the closer we get to expiration, the more expensive, in relative terms, more expensive things will get, right? So if I wanted to add another butterfly, I would have to put up maybe another $20,000. Whereas if this trade had 70 days, that same butterfly would only cost, maybe a couple of $1,000s. So the closer we get to expiration, the more adding risk is going to cost. I don't want to do that. I think the best or the path of least resistance, at least for me, is going to be to start to pinch in the wings, which is what we normally would do. So if I take my upper long down, I don't know, maybe 30 points, which is pretty aggressive, right? That's going to bring in the credit, way more credit than what I spent today, or at least based on today's prices, right? And if I want to control my downside risk, I can once again roll my downside longs up a bit, right? Spend some of that credit that I'm bringing in. Let's see what that would look like, right? So maybe I won't remove or replace all of the downside risk, but I can unlock my upside risk. As you can see, this green line is the new or adjusted risk graph at expiration. So this blue line is what my risk graph looks like right now. But if I was to make this adjustment, right, you can see that at expiration, I no longer have any more upside risk, which means that if the price is going to move higher and the market is rallying, I no longer have to actively babysit and manage this trade on a day-to-day basis. I can let it run out and expire wherever it may be, 5,050, 6,000, 6,050, whatever. Right? I only have to worry about downside risk. But I think it's a little too soon for this because we're still inside this structure and the market on any given day, right? We're rallying today. What does that mean? It means absolutely nothing. We can be down tomorrow. We can go even higher tomorrow and then reverse and go lower. We need to find some evidence that makes us believe that maybe the market is done going down, right? This can be some key moving average crossover. We can look for MACDs. We can look for squeeze, whatever whatever is going to confirm our suspicion that the market may saw the worst and ready to turn. I think it's just too soon right now. There's no evidence to make that call. Okay, and again, I don't like to make adjustments based on what I think might happen. When I see something in the charts, they're telling me that what the odds of higher right now are greater than odds of lower. Then I will start to shift risk from upside risk to the downside risk, or drag both wings in. And again, the goal would be to unlock the upside risk. Now we can probably do something similar on the downside. And if that's what you're thinking, right? Like what if the market was to move lower from here, right? Couldn't we do the same thing on the downside? And the answer is yes, right? For example, if the market starts to move lower and now we're, you know, it looks like we may be going below the downside break even. Why couldn't we just take this downside long and move it up 30 points? And let's see what that looks like. And I say 30 points, I don't know if that's, if, could it be the answer? Maybe. But I have to see what it looks like. So if we move it 10 points, 20, 30 points, right, from 56.90 up to 57.20, that's just, it's the same exact as buying a 57.20, 56.90 put debit spread. So it's going to be a debit transaction. But you can see by doing that, yes, will increase my upside risk, but I will remove a big chunk of my downside risk and I will end up in a balanced put butterfly with a slight, not slightly, but a decent amount of net negative delta. Right. So by just moving the wings on either side, I can control my directional exposure, and I can't control where this little ball is going to move, but I can control these spreads or the widths of these spreads, right? To kind of wherever this ball is moving, that's where I have to take care of the problem, right? Right now, I have a small problem on the upside and a bigger problem on the downside. If the market's moving lower, I have to take care of my bigger problem on the downside. If the market is moving higher, I have to take care of the smaller problem on the upside. Hopefully, this makes sense, guys. And I'm saying all this not to confuse you, but to kind of show you that there's a lot of discretion, right? And once you understand what you're trying to accomplish, it's going to literally, I don't know if this is the right term, but it's going to unchain you from following someone. Like I don't want to be in a position to tell you how to adjust your trades, right? Because you may think the market's going higher while I think the market's going nowhere, or vice versa. Or you may have a 5 lot while I have a 10 lot, or you may have a 50 lot while I have a 2 lot, right? So there are no two adjustments that are exactly the same, right? It can be similar in the sense that they're both are going to accomplish the same thing, right? So for right now, right, if we are inside of this butterfly, I don't feel like I really need to do something until we start to threaten to move outside of the butterfly in either direction. If it's to the upside, I need to fix my upside problem. How do I do it? For me, I roll the wing in and then I drag the downside long up a little bit to control my downside risk. It's simple as that. How many points? Is it 10? Is it 20? Is it 30? It doesn't matter. You got to try it. What does it look like if I move it 10 points? What does it look like if I move it 20 points and 30 points? And then you figure out, right, what is that going to do to your net delta? Are you okay with it? If not, if it's too aggressive, then change it, right? There's so many ways to make these adjustments. They're all different, but they're all are trying to accomplish the same thing. Let me see. Sorry, I don't understand the adjustments. Still learning. Did adjust the put debit spread part of did I? I'm not sure if this is the question. Did adjust the put debit spread part of the butterfly? I adjusted. I rolled. So today, what I did, I changed the width of the put credit spread. I made it less. I made it narrower. Right before today's adjustment, you can see before I made this adjustment, my long put was at 56.70. And then I sold to close. And it doesn't matter. Are you selling it for a profit? Are you selling it for a loss? Don't look at it that way. I mean, I don't, only because if I'm selling it, it's probably at a profit. But if it was for a loss, will I not make the adjustment? I know I need to make an adjustment. So if I'm sitting there and I'm stopping myself from doing the adjustment because if I sell this long put, it's going to be at a loss, and I don't like taking losses. You're thinking about it wrong, right? My goal was to add a put debit spread. I could have added 5,700, 5670. Well, let's stop going to 56. Let's do a 20 wide, except we'll use different strikes so that I feel like because we're using options that we already have, it may be throwing some people off. So maybe instead of rolling the downside long, forget about rolling it. Let's say we're here, market is selling off, I need to make an adjustment. I'm just going to add a 20-point wide put debit spread. So I'm buying 5,700 and I'm selling 5,680, right? It accomplishes the same exact thing. It cuts my delta, right? It's just going to introduce more legs or more strikes to this already multi-leg position. So instead of having 10 on 5,700, 10 contracts at 5,680, 10 contracts at 5,670, it's not a problem. But instead of having options all over these or on many different strikes, I just like to use what I already have. Right. So I ended up, instead of selling to open 5,680, I sold to close 5,670. But it's exact same thing where, again, you can say which one is better. They're both are fine, in my opinion. Because why? They're too different, right? One is a put debit spread that's a little bit farther out of the money. The other one is a put debit spread that's a little bit closer to at the money. They're both 20 points wide, but they both accomplish the same thing. So which one is better? I don't think there's better. I think they're both fine. Right? So and if you said, and the reason why I want everybody to learn to think for themselves, so that if you say, well, I have a position that's kind of getting in trouble, I need to figure out a way to remove maybe 2/3 of my delta, right? I go and I buy a 20 wide at 5,700, 5,680, and you go and you buy a 20 wide or a 30 wide, something like this, right? This will neutralize almost all of my delta, so that's not good. And you end up doing, maybe you choose slightly different strikes, but in the end, the net result is going to be the same. Let's say you didn't want to do a 10 lot here and a 10 lot here because you wanted to save on fees and commissions. You said, well, I want to only do a 5 lot. Okay, no problem. So instead of doing a 10 lot 20 wide, you do a 5 lot 40 wide. Is it not the same thing? Right? So from 5,700 to maybe 5,660. Right? Again, a different spread, it's still a put debit spread. It's less number of contracts, but it's wider. But if you look at the net delta difference, it accomplishes basically the same thing. Right? So it's not like, well, you said buy a 10 wide, why did you do a 15 wide or vice versa? I think that this will, in the end, it'll cause more confusion than anything else. You have to understand where you're trying to get to, and then you try to figure out. You can look at a few different adjustments and figure out which one you like better, right? You can bounce some ideas around, and we could, debate and discuss which one is more effective and which one isn't, and whatnot. But in the end, as long as you know where you're going, or at least you know where you want to go, then you can figure out what is the path of least resistance to get there. And you can argue that, hey, 40 wide, 5 lot is better than a 20 lot, 10 lot, 20 wide, right? Exactly what I just showed, right? So you do a 5 contracts, 40 wide, or you do 10 contracts, 20 wide. In the end, they kind of do the same thing, but if you wanted to isolate each and then look at the Greeks and understand which one will perform better in different market environments and so on, but I don't think that they make such great difference that one is great and the other one isn't. They both are great because you're going to take down your delta, and that means if the market rolls and moves against you, you're going to be in a better spot. All right, good. Yeah. So if you understand it, that's great. Um, Again, and I found myself a lot in situations where it's like, okay, I get it, and then like, you know, next day, I'm not sure. Let me go back and you go through this process of trying setting up different adjustments, and especially if you can visualize and see how this is going to change your risk graph, and you can look and understand how this will change your Greeks. The more you do it, the faster it's going to become second nature. So I definitely suggest, you know, use whatever software you have. If you have Option Explorer, great. If you don't, you accomplish the same thing using Thinkorswim Analyze tab. It's maybe a little bit different, but as long as you can, and again, seeing your trade and also being able to tell what is your current running profit and loss in the trade, right? Because in your head, right, you start to count, well, I sold that put for X amount and then I bought it back for X amount. So I made some money there, but then I rolled that put into something else and I remember what I paid for it. So now, three adjustments later, I have no idea where I'm at the trade. So how do you know if it makes sense to continue to fight for it? Wouldn't it be easier to maybe give up on step two because you already put yourself in the position of, best case, you may just break even. So what's the point of doing that? Right? Knowing what your current running profit and loss in the position is also a very important thing is um, because sometimes you do one adjustment, two adjustment, and then you're like, well, I'm not really sure what's happening, or how close am I to break even, or am I still inside the tent, and how much risk do I have on the upside, how much risk do I have on the downside, and especially if you're considering and thinking about making any kind of adjustments, how do I know what rolling my downside long up 20 points will look like on the risk graph? I mean, after doing this for 15 years with Option Explorer, I can get an idea of how this risk graph is going to move. But you don't want to trade based on some assumption. Hopefully, you're right, how you think about it, and I think using some kind of software would definitely help. One more thing, let's talk about the similar adjustment to a 112. Would it work? And I'm going to pull up a trade that I have. And, these are 112s and the way they're structured, right? The structure of the trade is a 112. Um, but this trade has evolved a little bit, and now I don't really have the trap anymore because my put debit spreads are wider. They're farther out of the money and they have more time until expiration when compared to the front month or the short naked puts. But the core of this position, and this position has been on for 2 weeks, right? 14 days in. The underlying asset, which is the E-mini S&P 500, has moved about 2.5 standard deviations to the downside. I'm assuming this is information is correct. I'm not sure, but you can tell that we have moved in 2 weeks way more than what was priced in at the time when this trade was entered. Implied volatility increased 100%. Again, I'm not sure if these are accurate or if they're really irrelevant to me. Yes, I know volatility has increased. Yes, I know we moved outside of what was being, priced in. I just need to see my graph. I need to know my Greeks, and I need to know what is my next, what am I going to do here? Right. So what happened was I set up this trade. And if you are curious to see what's happening with this trade, this was already adjustment. So this is what I put this on, I top tick this perfection. And then as soon as I put it on, the market started to roll. I made my first adjustment. The market continued to roll, and that's where I brought in the put. The put was brought in on Feb 28th. So if you want to go check it out, it's trade number 3104. And then you'll see on Feb 28th, I brought in that put. I made some comments about it, and I also talked about it in our last Zoom meeting, which was, I believe, was on the 28th, which was last week on Friday. But um, the put that I brought in was a 5,700 strike put. It's currently going for $91.75. I paid 85.50, maybe $85 for it. So it's up a little bit, right? Market's going up, market's going down. Yesterday, when the market was selling off pretty hard earlier on, this put was trading as high as $130, I think. Right. So I could have said, well, I bought it for 85. Now it's at 130. Why don't I just grab this, low hanging fruit, and it's a nice easy profit. I didn't do anything for it, but that would have left me again. What is this put doing? This put is adding negative delta. Right now, I'm holding almost no delta in this trade. This was my goal. My goal of this adjustment was to take out all the delta. I don't want to have the delta because I'm not sure which way the market's going to move. We already moved, over 2 standard deviations to the downside, which means that it's reasonable to assume that maybe market's getting a little overdone. Maybe we're a little too stretched to one side, and we're probably due for a bounce. But there's really no good evidence to suggest that that bounce is going to happen now. So I brought in that put, and that took out all of my delta. When the market was selling off pretty good yesterday in the morning, right? My P&L wasn't much different than it is today. And today we are definitely higher than where we were at the lows yesterday. So the P&L swings, I stopped my P&L volatility. It was down maybe, I don't know, 27, 28, maybe 2,900 yesterday near the lows. Yes, that's because volatility was also higher, right? I'm still short Vega here, so I'm going to lose a little bit of money on the move down, and if volatility is going to increase, but it isn't going to be much. Basically, what happened was when the market was pushing lower yesterday, any losses from the 112 were pretty much kept in line, right? Everything that 112 was losing, this 5,700 put was gaining. So it kind of neutralized my position, and that was the goal. So what happens now? Well, I don't know. If we go higher, guess what's going to happen? I'm going to lose money with this put. Am I okay with it? Well, there's nothing I can do about it, right? That's the cost. That is the price, right? To have a peace of mind that if the market is down 150 points tomorrow, this is going to be like fighting in slow motion, right? I have the options. I have the time that I need to think about what's my next move. I can model and play around with different couple of adjustments. It's just going to slow things down because as you can see on the way down, I don't really start to accumulate, significant positive delta until we, go down below maybe 5,600, right? The curvature of this T plus zero line doesn't really start to accelerate until we go under 5,600. So yeah, I can, this kind of buys me the time. I like to call these a speed bump, right? Things are starting to, it's kind of like, I guess this is a good analogy from Dan Sheridan, right? Like if you're driving on the highway and you're going 100 miles an hour and, it starts to rain or it starts to snow, are you going to accelerate or are you going to hit the brakes? So this is like hitting the brakes, right? I bought the put, I slow things down until this rain stops and I get a better idea of, how to navigate from here. So I brought in this put. If we're going to bounce and there's good evidence to suggest that we're going higher, right? As you can see on the way up, I go from slightly positive delta, and now I'm going to start to accumulate negative delta. I don't want to hold negative delta on the way up, so I can sell this put, and odds are I'm going to lose some money on it. My only job is going to be to figure out how to recover what I might lose on this $5,700 put. right? So this put is not a must. Would I do it every single time? I would try not to do it. But if the market is really getting, the way it was yesterday, it really, and volatility, the VIX, I don't know, it reached to as high as maybe 25 or something like that. It definitely didn't feel good. And that's why I brought in this put, just to kind of freeze things a little bit, give myself time to think. And this way you don't have the emotions flying all over the place and while you're trying to figure out, how to move next. Question: did you buy an at the money put or enough to get Delta to where you wanted it? You answered your own question. I didn't need to do it at the money. I didn't have enough positive Delta to use an at the money put. I think that I bought this put on Friday, and on Friday the market was trading at maybe 5,900 or something like that. So it was 200 points out of the money, but it was enough to get me almost to flat Delta. If you look at the trade 3104, you'll see. I think I left comments of what I was trying to accomplish. If I didn't, yeah, the goal was to cut net exposure to close to zero. Kind of like, I don't want to be long, I don't want to be short, I just want to watch and see what happens next. And then when I get an idea of where we're going to go next, I could make another adjustment. If I really, like, for example, if the market, for whatever reason, market's taking off and I'm saying, oh crap, you know, um, I need to figure out um, how to unhedge this position. Well, I can just go as simply as and sell this put, right? Or maybe if this put is, if the market is rallying and I'm ready to unload this hedge, it's probably not trading at 90. It's probably trading at maybe 60, right? It's trading at 60 and I lost 25 points. Oof, that's not good. So what am I going to do? I can go and I can sell, right? So I had 85 I paid for it and then I sold it and I lost 25 points. So we'll add 25 to 85. I need to sell a put for about 110 to recover. So yeah, I'm going to take a slight haircut on potential profit, which I'm probably not going to make anyways. Somewhere, in the neighborhood of 57 down to 5,500. I don't really care because I was never going to make this profit anyways. But I gave myself, right? I removed that debit that I paid. You can see this blue line is below zero. I have a debit. And if I sell a put aggressive enough to not just recover the $85 that I paid for this $5,700 put, but also to recover the $25 loss that I may take on that put, right? I have to move closer to at the money. And you can see my delta goes from neutral to plus 18. But in order for me to get there, I need to see something in the charts that is telling me that, hey, market's going higher. You're behind with this put. It's time to get rid of it. Let's go to work. All right. So that's it for me. I know that I was kind of all over the place. Hopefully um, you got to thinking. Maybe you picked up something new. I would love to hear your feedback. Let me know. You could always find me on Discord. We'll be back on Friday. I'll try to update on these charts, and if something changes and if I'm going to make adjustments to my trades, I always post them on Discord. You're welcome to ask questions there as well. Otherwise, the market just closed. Um, it looks like we did not poop the bed into the close. So maybe if we do get some sort of follow through, um, we can build on that. But for right now, I think that it's still kind of shaky, and I wouldn't commit too much to holding overnight short-term trades on S&P because again, we could walk in tomorrow to being down 50 points. I don't know. We could be up 50 points. It's really hard to tell. Um, and with the VIX at 2191, we talked about this the other day, guys. If you want to kind of get an idea of what is normal with the VIX at 22, you divide 22 by 16, That gives you about 1.35. So with the VIX at 22, expected range for one day is plus 1.3% or down 1.3%. So 70% of the time, we're going to be somewhere inside of that plus one and a third to minus one and a third percent. So, these 1% swings up and down might feel like the sky is falling and it feels really bad and it feels like it's a lot. But with the VIX at 22, that kind of volatility is justified. Well, let's do one quick question and then I'm going to let you jump. Um, Quick question on 112C. Does the leftover put debit spread wall create a good vol hedge for the future? It's not a volatility hedge, it's more of a delta hedge. And, if you're looking for a delta hedge, you can probably look for a pure delta hedge. But yeah, I mean, a put debit spread is a delta hedge all in itself. Other than, a leftover put debit spread, it may be old, meaning that it decayed some. It may be very far out of the money. It may have very little time left until expiration. So no two put debit spreads are exactly the same. It all depends on, what kind of leftover put debit spread you have. And if you have like 3, 4, or 5 layers of put debit spreads, the more you have, the better off you are. They're definitely helping you keep your buying power requirements in check, right? Because as naked puts will start to increase the BP usage, those put debit spreads will offset some of that BP usage. So that'll help from, having your buying power going upside down and having your broker to force liquidate your positions. If you are looking for a pure volatility hedge, leftover put debit spreads don't necessarily achieve that because you need to be net long option premium or you need to be net long gamma with your puts, meaning you need to have more longs than short. Like, for example, buying 10 longs and financing them with, maybe 2 or 3 short puts, right? So you buy 10 puts and you sell maybe 3, maybe 4 or 2, whatever that ratio that would work best for you. You short 3 puts and then you use the credit that you collect from shorting 3 puts to buy 10 long puts that will give you a net plus 7 puts. So that's more of a volatility hedge. All right. So, but leftover put debit spreads definitely will help, especially if your naked puts are getting in trouble and you need to roll them out and you can't roll them for a credit, you're rolling them for a debit, which means that you need to sell something to cover the debit. And what do you sell? You sell the put debit spreads because that is what their job is, to provide the credits you need to offset your debits. All right, I'm going to run. I'm going to catch you guys on Friday. Have a good rest of the day. I'll see you guys next time. Take care, everybody. Bye bye.